welcome to Oliveboard and a very warm welcome to everyone here. Good evening, everyone, and a very warm welcome to everyone here. I am hoping that I am visible, my audio is audible, and my screen is visible to all of you. I hope you all are fine and doing good. So, today the marathon session is dedicated to module D. We will see all the top MCQs here. We will discuss the related topics here related to the MCQs, and we will try to cover all the things with the help of these top top basically MCQs. And yes, tomorrow we have a special class for our numericals and all the case studies. We will try to cover all the top case studies and the numericals which are related to module A, module B, module C, module D, and then next day we have final marathon part 1 for in that class we will cover module A and module D first, and then next day we will cover module B and C. So that is a combination. In that classes I will provide you the all the overview of every chapter, every unit, even most important topics from every module. So let's start with our today's class. So here I am sharing the all questions. First question is in your screen. So this is the balance sheet management module D, and we have these units. We have to cover the top questions from these units. So we will try to cover all the MCQs from these units. First question is there, which act requires companies to present their financial statements, balance sheet and profit and loss account in the formats laid down in schedule 3rd. So for this I am going to tell you about some thing about the companies. A company, just give me a second for this. A company basically which is registered under the Companies Act 2013, it is required to present its financial statements, that is basically balance sheet and profit and loss. Profit and loss account in the financial statements or in the formats which is laid down in the schedule 3rd of the Companies Act. And also government notified that the accounts of the banking companies shall be closed on 31st March every year as against 31st December earlier. Okay, 31st March is now government notified that accounts of the banking companies shall be closed. So our first question is saying, which act requires here companies to present their financial statements, balance sheet and profit and loss account in the formats which is laid down in schedule 3rd. So after reading the options you will find that option B is correct. Okay, option B is correct. Next question is saying, according to the recent notification, on which date must the accounts of banking companies now be closed annually? According to the recent government notification, on which date must the accounts of banking companies now be closed annually? And also sorry for the voice because I am having some type little bit cold, that's why voice is changed. So according to the recent notification, I told you that the government has notified that accounts of the banking companies shall be closed on 31st March, and earlier this date is 31st December. So the correct answer is option C. Okay, I hope this is clear. Now third question is saying, under which schedule of the Banking Regulation Act 1949 is the format for the balance sheet and profit and loss account of the banks provided? Under which schedule of the Banking Regulation Act 1949 is the format for the balance sheet and the profit and loss account of the banks provided? All the options are given: second schedule, fourth schedule, third schedule, fifth schedule. So for this, I am going to tell you about one concept. See, this Banking Regulation Act 1949 gives the format of the balance sheet and also for the profit and loss account, okay, in which the accounts of bank should be presented, and this format is given by the third schedule annexed to the BR Act 1949. RBI has issued the guidelines to follow the new form, that is A, pro forma balance sheet, and the form B, that is pro forma of profit and loss account, by all the banking companies doing business in India. So you can see now which option is correct. Third schedule is correct. According to the Section 29 of the Banking Regulation Act 1949, who is required to sign the financial statements of a banking company incorporated in the India? Okay, great. Mintu ji and Yogesh ji. Okay, B. So, see, Section 29 of the Act requires that the financial statements of banking company which are incorporated in India should be signed by the or principal principal officer of the banking company, by at least their directors in case the number is less than there. Basically we can say these the financial statements of the foreign banking company are to be signed by the manager or the agent of the principal office in the India. And the provision of Section 29 are also applicable to the nationalized banks like SBI, also RRBs, some small finance banks and payment banks. So here we can say the correct answer is there, option B. The managers or the principal officer and at least 3 directors. Yes, B, as all options are clearly eliminated. Athar sir, very good. Which of the following entities are subject to the provisions of Sector 29 of the Banking Regulation Act 1949? And I told you this: nationalized banks, SBI, RRBs, all finance banks, and all the payment banks also there. Okay. Very good. Who must approve the appointment, reappointment, or removal of an auditor for a banking company? Who is responsible here? See, accounts must be audited by the person which is duly qualified under any law for the time being in force to be an auditor of companies. However, every banking company is, before appointing, reappointing, or removing of an auditor, required to obtain the prior approval of the RBI, that is Reserve Bank of India. Very good, Yogesh sir. Now, according to the Section 32 of the Banking Regulation Act 1949, when must a banking company submit 3 copies of its annual accounts and auditor reports to the registrar of the companies? According to the Section 32 of the Banking Regulation Act 1949, when a must banking companies have to submit their 3 copies, basically these 3 copies of balance sheet and the profit and loss prepared under Section 29 together with the auditors under Section 30 must be submitted to the RBI within their months from the end of the period to which they refer. Basically, this Section 32 of the Act requires a banking company to furnish these 3 copies of its annual accounts and the auditor report thereon to the registrar of the companies at the same time when it furnishes these documents to the RBI. And we can say that Rule 15 of the Banking Regulation 1949 prescribes that accounts and the auditor's report shall be published in a newspaper which is circulating in a place where a banking company has its principal office within 6 months from the end of the period to which they relate. So we can say within 6 months from the end of the financial period is the correct answer here. Right? Wait. Just give me a second. Yes, the answer will be option D. According to the 15 rule, banking company publishes accounts and auditor reports in a newspaper in within 3 months from the end of the financial period. So these two questions, two different answer. According to the section 2, within 6 months, and according to the section 15, the circular will be in the newspaper within 3 months from the end of the financial period. So here the option A is correct. Understand? Next, under the Banking Regulation Act 1949, within how many months must a banking company, this question is repeated. Okay, now what is the primary objective of ALM? What is the primary objective of ALM, that is asset liability management in the banks? So let's understand what is the meaning of ALM first. ALM, we can say, is concerned with the strategic balance sheet management, and it involves risk that is caused by the changes in the interest rates. Okay, changes in the interest rate, exchange rate, and credit risk, and the liquidity position of the bank. With profit becoming a key factor, it has now become imperative for a bank to move away from the partial asset management and non-performing asset and the partial liability management towards an integrated balance sheet management where all the components of balance sheet and its different maturity mix will be looked at from the profit angle of the bank. And this asset liability management techniques is designed to manage various types of risk. Primarily, this aims to stabilize the short term profits, long term earnings, and long term quality of the bank. The parameters that are selected for the purpose of stabilizing the ALM of banks is NII, that is net interest income, NIM, that is net interest margin, and also economic equity ratio. Okay, so primary objective is basically to manage the risk associated with the interest rates, exchange rates, credit risk, and the liquidity. So the B option is correct here. Which of the following is not a key parameter used for stabilizing asset liability management in the banks? B. Yes, correct. Yogesh sir, Athav sir, correct. B answer is correct. Now, in this case, which of the, yeah, very good. Option D. Very good, everyone. Option D is the correct answer. Clear. Now, tell me, according to the concept of ALM, that's why I told the concept here. According to the concept of ALM, what shift is now imperative for the banks to adopt? So, after reading all the options, we can say here, correct answer is moving from partial asset and liability management to integrated balance sheet management. This answer is correct. I told you that this is the concept for the asset liability management. Now, what is the primary measure which is used to assess the impact of volatility on short term profits in banks? What is the primary measure? See, impact of volatility on the short term profit is measured by the net interest income. And net interest income formula is interest income minus interest expenses. In order to stabilize the short term profit, banks have to minimize the fluctuations in the NII. So we can say the correct answer is NII. Option B is correct here. Very good. How is net interest margin calculated in banking? Option B, net interest income is divided by average total assets. This is the formula for NIM. This is the formula for NIM and this is the formula for NII. Net interest margin. What does the ratio of shareholder funds to total assets assess in a bank? What does the ratio of shareholder funds to total assets assess in a bank? See, the ratio of the shareholder funds to the total assets measures the shifts in the ratio of owned funds to the total funds. This fact also assesses the substance capacity of the bank. So answer is option B. Okay, this option is correct here. What was one of the key recommendation of the Narasimhan committee regarding this balance sheet of banks? Okay, so if we talk about August 1991, a high level committee headed by M. Narasimhan was appointed to examine various aspects of the financial system. And one of the important recommendation of the Narasimham committee was that balance sheets of the banks should be transparent and also comply with the international accounting standards. The committee recommended that banks should adopt uniform accounting practices in regard to income recognition and bad debts. Okay, in particular, income recognition of non-performing assets should not be on accrual basis but on record of recovery. And this committee also suggested that provisioning should depend upon on a proper classification of assets, which in turn should be based on on objective criteria. So after reading these options, you can find which option is correct. Yes, Rajni ma'am, answer B is correct here. Okay, banks should ensure that transparency in their balance sheets and comply with the international accounting standards. According to the Narasimham committee, how should income recognition for non-performing assets be done? It is done on the basically what is NPA, and NPA basically we can say is a leased asset, and it become non-performing when it ceases to generate income for the bank. Banks should classify an account an NPA only if the interest charged during quarter is not serviced fully within 90 days from the end of the quarter. So here we can say option B is correct based on expected recovery. Okay. And when does an asset become a non-performing asset for a bank? When it ceases to generate income for a bank. Okay. And according to the guidelines, how long after the end of a quarter should interest be serviced? Interest be serviced for a bank to avoid being classified as an NPA? Tell me, I told you this recently about this. Which answer is correct according to you? Very good. Atharv sir, 90 days is the correct answer. Now, in case of a term loan, an asset is classified as non-performing asset if the interest or installment of principal remains overdue for a period of more than how many days? Let me tell you here the some concept about this. NPA is a loan. We know NPA is a loan or an advance where basically interest or installment of the principal remain overdue for a period of more than 90 days in respect of a term loan. The account remain out of order. We will discuss questions on out of order in respect to an overdraft and cash credit. Bill remains here overdue for a period of more than 90 days in the case of bills purchased and discounted. So here which answer is correct? 90 days. Now, in the case of short duration crops, which asset will be classified as an NPA? Basically, the installment of principal or interest thereon remains overdue for one crop season or one crop season for long duration crop. So we can say if the installment of principal or interest is overdue for 2 crop seasons is the correct answer here, option C. Yes, 2 crop seasons. Answer C is correct here. Okay, out of order status. What should an account be classified as out of order in banking. An account that should be treated as out of order if the outstanding balance remains continuously in the excess of sanction limit or drawing power. In the cases where the outstanding balance in the principal operating account is less than the sanction limit drawing power, but there are no credits continuously for the 90 days, as on the balance sheet, as on the date of the balance sheet, or the credits are not enough to cover the interest debited during the same period, these accounts should be treated as out of order. So when we read the options, you will find that which option is correct: when the outstanding balance is continuously in excess of the sanction limit drawing power. That means our option B is correct. Yeah, great. Again, a term loan asset will become NPA if the installment or interest due remains unpaid for a period of NPA when asset become, it ceases to generate income for the bank, and a term loan asset will become NPA if the installment of principal interest due remains over for a period of more than 90 days. Of more than 90 days. Athar sir, 90 days are there, but more than 90 days. Okay. The general provision in respect of substandard asset is basically, what is this substandard asset? Substandard asset is a non-performing asset that had been in that category for less than 12 months. Okay. And also we can say our doubtful assets are there. Loan assets are loss assets, like loans with losses identified the banks, auditors, inspectors. And also, yeah, see, a non, I clear here 15 and 20 in between 25. See, a non-performing asset causes the impact on the profitability of a bank. The bank is required provisions for this asset depending on the classification, category of the asset and the value of security. So the general provision is basically of 15% on the total outstanding is made for substandard asset. Clear? That is 15%. I hope clear to everyone. Option A is correct here. Okay. Here option A is correct. If loss asset is not written off, provision has to be made to the extent of if a loss asset is not written off, provision has to be made to the extent of. See, a loss asset is one where the loss has been identified by the bank or internal or external auditors or by the RBI inspections, but amount has not been written off wholly. And also, loss assets should be written off. If loss assets are permitted to remain in the book of any region, that we can say 100% of the outstanding should be provided. So we can say the answer is 100%. Yes, answer G is correct, Rajni ma'am and Yogesh sir, very good. As per the prudential framework for the resolution of stressed assets, if principal or interest payment or any other amount, wholly or partially overdue between 31st to 60 days, it will be categorized as special mention account. See, we will see the categorization for SMA to 0, basically subcategory principal or the interest payment or any other amount wholly or partly overdue between 1 to 30 days. Then for SMA 1 there is 31 to 60 days. Then SMA 2 there is 61 to 90 days. Okay, and also in order to reduce the NPAs, RBI has come out with a prudential framework for resolution of stressed assets for providing early recognition, reporting and time bound resolution of stressed assets. Loan account that show the sign of here some type of default, immediately on default, to be classified as special mention accounts, and these are the categories. So the answer is for the 31 and 60 days, that means option B is correct here. Clear? Yeah, option B. Great everyone. Yogesh sir, Atharv sir, Rajni ma'am, Lakshman sir. Now, which is the central system which is set by the RBI for the lenders to report credit information, including the classification of an account as SMA on all the borrowers having aggregate exposure of 50 million and above with them. See, RBI has set up the Central Repository of Information on Large Credit, in short CRILC, to collect, share, disseminate credit data to the lenders. And also, banks are here required to report credit information, including the classification of an account as SMA to CRILC on all their borrowers having the aggregate funds based and non-fund based exposure of rupees 50 million and above with them. However, crop loans are exempted from such reporting, but banks should continue to report their other agricultural loans in terms of the above instruction. So we can say option B is correct here. Clear? Okay, so moving forward, if you liking this session, kindly give the thumbs up. And then the next question, loans which are NPA or over 48 for over 48 months are categorized under which category? If we talk about the current provisioning in respect of non-performing assets are as under, we can say the asset classification. You will see this is the asset classification and period as NPA. So for the substandard, just see for the substandard. Yeah, for the substandard it is up to 1 year. Okay, for doubtful first category it is for second year, and for doubtful second it is third and fourth year, and for the third doubtful category it is fifth year onwards. So 48 will come under the substandard category. Option D is correct here. Okay, option D is correct. Option C, why C? Option D, Yogesh sir. Okay, moving to the next question. What is provisioning coverage ratio? Provisioning coverage ratio, PCR, is essentially the ratio of provisioning to gross non-performing assets and indicate the extent of funds a bank has kept aside to cover loan losses. So option A is correct. Ratio of provisioning to gross non-performing assets. Unsecured exposures, which is identified as substandard, would attract the additional provision of a general provision of 15% on the total outstanding should be made without making any allowance for the ECGC guarantee which cover the securities available, and the unsecured exposures which are identified as substandard would attract additional provision of 10% too. So total is 25%. That 25% is the correct answer. Which one? Oh, for over 48 months. That means, sorry for this, over 48 months. This is over 3. Yeah, over 48 months. Yes, you are right. Sorry for this. I explained the categories and I forget this. Over 48 months, that is not correct. This is, yes. This is D3. Correct. Very good. Thank you. I confused. I correct. I think that 48 months are 48 days. That's why I choose option D. Thank you so much, Yogesh sir, Athar sir. You and now it correct. Thank you. This is 48 months. That's why reading the question concentrately is important. Thank you. Okay. According to IB, this question is clear? Yes. According to the IBC 2016, how many classes of persons can trigger the corporate insolvency resolution process, that is CAIRP? See, this IBC basically set out the three classes of the persons who trigger the corporate insolvency resolution process, financial creditors, operational creditors, and corporate debtors. These three classes are financial creditors, operational creditors, and corporate debtors. Okay. In regard to the secured portion what will be the provision requirement if the advance has remained in doubtful category for up to 1 year in regard of the secured position. If we talk about in regard of the secured position, provisions may be made like period here, period for which the advances has remained the doubtful category, and also the provision that is required, provision requirement. I think for the up to 1 year, up to 1 year, that is 25%, and for the 3 year, 1 to 3 year, that is 40%, and for more than 3 year, it is 100%. But question is asking up to 1 year, that means 25 is correct. Up to 1 year, 25%. Okay? Yeah. Moving to the next one. Which of the following is not required with regard to the general provision for standard assets? So basically banks are required to make the general provisions for the standard assets. Some of the rates are there, like for the, if we talk about for the farm credit to agricultural activities and the SMEs sectors, it is at 0.25%, and the advances to commercial real estate sector, I am just telling you for revision, is 1%, and whatever the advances to the commercial real estate residential housing sector is at 0.75%, and housing loans which is extended at teaser rate is 2%, and the provisioning on these assets would revert to 0.40% after the 1 year from the date on which the rates are reset at higher rates if the account remain standard. And also the advances restructured, I'm writing this, you will understand better. So the advances that restructured and classified as standard in terms of the Master Direction Reserve Bank of India, that are basically relief measures by the bank in areas affected by the natural calamities direction 2018. SCBs are updated from the time to time at basically 5%, and all other loans and the advances not included above is at 0.40%. So if you clearly read all the options, not correct is there, we have to find. So the general provision for advances to commercial real estate is at 1%. This is correct. General provisions here for the to housing loans extended at teaser rate is 2%. Okay, and also third option is the answer here, because in the case of commercial real estate residential housing sector is 0.75%. So option C is correct here. Yeah, C option is correct. In RRBs, what you are saying, Yogesh sir? Next question till then. Which of the following is true about substandard asset? Just read the options carefully. And I'll give me 1 minute. If we talk about the substandard assets, with effect from 31st March 2005, a substandard asset would be one which has remained the NPA for a period less than 12 months. In such cases, the current net worth of the borrower, guarantor, or the current market value of the security charge is not enough to ensure the recovery of the dues to the bank in full. So, if we talk about the correct answer, which is the following, is true. Option D is true. Okay. Option D is correct here. No, these are not different. These are the general rules. If these are different for the other bank, they mentioned, but not different. Understood? D option is correct. Till this question everything is clear. If you have any doubt you can ask, and also I am saying that if you want to say anything like any improvement, any feedback, you just share. I am sharing that every question I choose according to my thinking that this question will be best for you. So I choose the best ones for top MCQs. Basically, after doing the all previous year analysis, whatever the resources I got, I just take the questions, and I made also my own questions, and I try to cover at least 90-100 questions in today's session. So yeah, if any type of feedback, any type of suggestions, any type of appreciation, everything is acceptable. Just I want that you all clear your exam. That's all. Moving further, Basel Committee on Banking Supervision published principles for the sound liquidity risk management and the supervision in September 2008. Which principle of sound liquidity risk management is related to the public disclosure? Principle 1, Principle 2, Principle 11, Principle 13. And I know everything is not possible to cover in this module wise session, but I am assuring you, join my final marathon. I will cover everything in that sessions. In the theory basis, I will cover everything. Okay. So try to give the answer for this question, then I will explain to you with the concept. See, Basel Committee on Banking Supervision published the principles for sound liquidity management and supervision. And also went in September 2008. If we talk about this principle 13, that is related to the public disclosure. Principle 13 is related to the public disclosure. Principle 13, a bank should publicly disclose all the information on a regular basis that enables the market participants to make an informed judgment about the soundness of its liquidity risk management framework and liquidity positions. So the correct answer is option D, that is principle 30. Yeah, now understood. And also, sorry for the voice today. I am having cold, and that's why it's little bit disturbing voice are coming to you. But now this is clear, Yogesh sir. Now moving further. Okay. How many stock ratios have been illustrated in the guidelines on liquidity risk management by banks issued by the RBI? How many stock ratios? See, let's discuss this. The guidelines on the liquidity risk management by the bank issued by the RBI basically have given some illustrative list of 7 stock ratios. Up now, let's see. These are the critical ratios in the opinion of RBI in respect to liquidity risk management and also carries significance for the banks. What ratios are these? First one is volatile liabilities minus temporary assets divided by earning assets temporary assets. Okay. Second one is core deposits divided by total assets. Okay, I am writing this. And third one is loan plus all the mandatory SLR plus mandatory CRR. Just ignore the spelling. CRR plus fixed assets divided by here total assets. Okay. Then fourth one is loans plus mandatory SLR plus mandatory CRR plus fixed assets divided by core deposits. Fifth one is temporary assets divided by total assets. Sixth one is temporary assets divided by volatile liabilities. And seventh one is volatile liabilities is divided by total assets. So 7 ratios are illustrated. Option D is correct here. Okay? Clear? A option, why A option is correct, Yogesh sir? Next question. Funding risk is the need to replace net outflows due to unanticipated withdrawal. Which of the following is a cause of the funding risk? See, funding risk is basically need to replace some net outflows due to some unanticipated withdrawal. Basically this premature closure of deposit, that one, which arises because of fraud causing. Okay. Fraud causing substantial risk, systematic risk, loss of confidence, and also liabilities in the foreign currencies. So we can say option D is correct here. First, second, third, fourth, all are the causes of the funding risk. Okay. Now, which principle here for sound liquidity risk management published by this BCBS on formal contingency funding plan? Which principle? Let me know. Okay, I am telling you that, see, that principle 11. Principle 11 is basically states that a bank should have a CFP strategies that basically clearly set out the strategies for addressing liquidity shortfalls in emergency situation, and that CFP should outline the policies to manage a range of stress environments, establishing the clear lines for the responsibility, which includes clear invocation and escalation procedures, and also regularly tested and updated to ensure that is operationally robust. So principle 11 is the correct answer in this. Okay, yeah, great, Surin sir. C, principle C option is correct. Great. Now, banks are required to submit the liquidity return as per the prescribed format to RBI. The statement is required to be reported in how many parts? Thank you everyone for liking this session. Thank you so much. See, banks are required to submit the liquidity return as per the prescribed format of RBI. The existing liquidity reporting requirements have been reviewed by the RBI, and some of the statement is required to be reported in the 5 parts. Now, what are these 5 parts? For the domestic currency, Indian operations; for foreign currency, Indian operations; for combined Indian operations; for overseas operations; and for the consolidated bank operations. So the option D is correct here, that is 5. Okay. Basel committee has laid down how many principles for supervisory review under pillar 2? Basel committee has laid down how many principles for supervisory review under pillar 2? Yes. See, Basel committee has laid down 4 key principles in regard to supervisory review, which is under pillar 2. Basically, principle 1, that is for bank should have a process for assessing their overall capital adequacy in relation to their risk profile. Principle 2 is supervisory should review and evaluate the bank's internal capital adequacy assessments and the strategies. Principle 3 is basically supervisory should expect banks to operate above the minimum regulatory capital ratios. And principle 4, supervisory should seek to intervene at the early stage to prevent capital from falling below the minimum levels that is required to support the risk characteristics of a particular bank. So here we can say 4 principles are there. Okay. Yeah, the Basel Committee on the Banking Supervision has agreed upon how many guiding principles on under Pillar 3 disclosures. The Basel Committee on the Banking Supervision has agreed here upon how many guiding principles on Pillar 3 disclosures. See, if we talk about the Basel Committee on Banking Supervision, agreed upon having guiding principles on Pillar 3 disclosure, there are 5 principles. Principle 1, disclosures should be clear. Principle 2, disclosures should be comprehensive. Principle 3, disclosures should be meaningful to users. And principle 4, disclosures should be consistent over time. Principle 5, disclosures should be comparable across the bank. So 5 answer, option B is correct. What is liquidity risk in the context of banking? What is liquidity risk in the context of banking? See, inability of a bank to pay its debts they are due without negatively affecting its financial situation is referred as liquidity risk. The risk develop as a result of timing between inflows and the outflows, where obligations are due before or after assets are reaching the maturity, and effective liquidity risk management requires quick and affordable way to convert the assets or increasing liabilities to raise enough money to cover all the obligations. So after reading all the 4 options, you can clearly see which option is correct. Option A is correct according to me. Yes, it's okay, sir. Now it is clear to you? Which of the following internal banking variable could cause issues with bank's liquidity? Which of the following internal banking variable could cause issues with the banking's liquidity? Yeah, we can say here rapidly growing assets. Rapidly growing assets without adequate funding on the liability side can result in a negative gap, which puts banks' liquidity at risk. This condition may make it difficult for the bank to meet its obligation and the funding needs, possibly leading to liquidity problems. So we can say here option C is correct. That is rapid asset growth that exceeds the liability side funding's capacity. Okay? Yeah, option C. Great. Again, which principle for the sound liquidity management by the banks as envisaged by BCBS is related to public disclosure? See, after the global financial crisis, in recognition of the need for banks to improve their liquidity risk management, this Basel Committee on Banking Supervision published the principle for sound liquidity risk management and supervision. And here principle 13 is related. to the public disclosure. So answer D is correct here. Yeah, answer D. As per the liquidity reporting requirements, which statement need to be submitted at monthly interval? Banks are required to submit liquidity return as prescribed format to the chief general manager in charge, RBI. And basically this thing is reported in five parts. I told you this for the domestic currency Indian operations. That is basically this periodicity with respect to statement of structural liquidity for the overseas operations is monthly, that to be required submitted at monthly intervals. So option C is correct here. Option C, overseas operations. Why foreign currency Indian operations? There is option C is correct. Sureen sir. Okay. What is expected from the banks in terms of liquidity and solvency? What is expect from the banks in terms of liquidity and solvency? See, banks basically are required to submit the liquidity return as per the prescribed format. I already told you. And in this case, a bank is said to be solvent if its net worth is not negative, and bank is solvent if the total realizable value or its asset is more than its outside liabilities. So we can say banks is that they are both liquid in short term and solvent in the long term. So here we can say which option is correct? D option is correct. Tell me the answer according to you. Both liquid and solvent. Okay? Yeah. Yes, Yogesh sir and Sureen sir. Option D. Now, which of the following measure is satisfactory for evaluating the performance of business line as it's consider risk? See, if we talk about this RAROC, risk adjusted return on capital, it is related to the concepts such as shareholders value analysis and economic value added. It takes into account the revenue, cost and risk on transaction or portfolio basis over a defined time period. In the past, performance are measured by yardsticks such as return on assets, which adjust the profit for the associated book value of assets, or also with the help of ROE, return on equity, which also adjusts profits for the associated book value of equity. So we can say which is correct. All of the above or RAROC? RAROC is correct here, because ROA or ROE is not satisfactory. So we can say here C is correct. Option C is correct. Now bank earn interest income through all of the above, because by the lending, investing in securities, and also investment in bonds. Option D is correct here. Easy, all the above. Yeah. Fee based income is derived which of the following sources? Basically, one of the major source, if we talk about one of the major source of banks income, is derived from fee based activities and some traditional activities such as demand draft, remittances, safe custody, guarantees, letter of credit continue to be the prevalent, and some of the new sources like depository services, also we can say internet banking and e-commerce have appeared to this scene, and banks also ventured into cross selling of other financial products such as insurance policies, mutual funds, etc. So all of the above is the correct answer. This is option D is correct. I think question is repeated but the different language, sources of funds. Okay, now new question. Question is saying, which of the following is a new entity set up as a development financial institution to support the development of long-term infrastructure financing in the India? New entity. Okay. See, if we talk about this National Bank for financing infrastructure and development has been set as a development financial institution to support basically the development of long-term infrastructure financing in the India. And with this, India has seen the birth of new entity in the financial market. Unlike banks, these DFIs do not accept the deposits from the people. They source the funds from the market, government, as well as the multilateral market and government, and also some institutions which are often supported by the government guarantees. So option B is correct here. Clear? Yeah, great, Surin sir. Clear? Now moving to the next one. Risk other than market risk, credit risk, operational risk are covered under, are handled by which processes? And you know that here market risk, when this risk is occurred due to the market fluctuations. Credit risk, when the borrower is unable to repay its loan or the principal amount. Operational risk, due to internal error of the banks. It may also include some external events which is beyond in the control of bank, and some human errors are there like software error or employees fraud, and external event like COVID-19 pandemic type situations. And in this we can say we learn about ICAP, internal capital adequacy assessment process, which is a very comprehensive process used by the banks to assess their capital needs in relation to various risks they face. It includes the it include those beyond market risk, credit risk, operational risk. These other risk might include liquidity risk, interest rate risk, reputational risk, strategic risk. ICAP is required under the Basel third framework to ensure that banks have adequate capital to cover all the material risk they are facing. So option A is correct. I hope ICAP is also clear to all of you. Yeah, option A. Which of the following is not a method of measurement of interest rate risk? See, if we talk about this repricing schedules, this method involves grouping assets and the liabilities which are based on when their interest rate are next subject to change. It is used to assess how sensitive a financial institution portfolio is to changes in the interest rate over time. If we talk about this gap analysis is used to measure the difference between the amount of assets and the liabilities uh, when they are matured with the specific time periods. It also helps in assessing the impact of interest rate changes or a financial institution net interest income is there. And if we talk about the basically measures to the sensitivity to of a bond price to interest rate changes. It is a key method which is used to evaluate the interest rate risk of fixed income securities, and it also helps in estimating how much the price of a security will change with interest rate movements. And if we talk about the simulation approach, this involves using the models. Why? To forecast how interest rate changes will affect our financial institution portfolio. And while this is a valuable risk management tool, it is typically seen as a broader method for assessing various types of risk rather than specifically a method for measuring interest rate risk in the traditional sense. So this is the not a method of measurement of interest rate risk. Yeah, D option is correct. Sound interest rate risk management involves the application of four basic elements in the management of assets, liabilities, and the obvious instruments, which is not one such element. So let's see about the four key elements. Basically, appropriate board and senior management oversight, and also adequate risk management policies and procedures are there. Appropriate risk management monitoring and control the functions are there. And if we talk about this comprehensive internal control, it is, while this includes the internal audit, external audit, and control, are not usually considered part of the core framework managing interest rate itself. So here we can say option D is incorrect. Means correct answer. Not such one element. Comprehensive external control and independent audits. Clear? All set for the next question. What is basis risk? What is basis risk? Basis risk refers to the risk that the interest rate changes on the different assets and the liabilities which do not move in the same way or by the same magnitude This is particularly relevant in the situations where a company is trying to hedge its interest rate exposure, but the asset or liability being hedged does not perfectly match the characteristics of the hedging instrument. So we can say the option B is correct. The risk that the interest rate of different assets and liabilities may change in different magnitude. Option B is the correct answer. Which of the following liquidity risk arises when a bank deal in swaps and options? See, here the correct answer is mismatch risk. Why? Mismatch risk is a type of liquidity risk which is arises when the assets and the liabilities have mismatched the maturities or cash flows, which can be basically which can be done by the bank engaging in the complex instruments like swaps and options. These instruments create the situations when a bank faces this liquidity pressures if cannot align or meet the cash flow obligations due to timing mismatches between the assets and the liabilities or the terms of the derivative contracts. So the option D is correct here. Okay. Why time risk? No time risk. The option is D. Okay. Okay. The objective of dash is to ensure that the banks have adequate capital to support all the risk in their business, as also to encourage them to develop and use better risk management techniques for monitoring and managing their risks. Okay. The objective that is described in the question aligns with the goal of pillar 2 of the Basel third framework, which is focused on the SRP. Pillar 2 SRP, that is supervisory review process. This pillar is designed to ensure banks not only meet the minimum capital requirements but also hold enough capital to cover the risk that are not fully captured by those minimum requirements. It also encourages banks to adopt the better risk management techniques and also engage in internal assessment of their capital adequacy. Okay, so option B is correct here. Pillar 2, that is supervisory review process. Clear? Everything is clear? Okay. No, pillar 1 is not the correct answer, sir, because this pillar is set out for the minimum capital requirements that banks must hold to cover credit market, operational risk, and also this is not directly focuses on encouraging the development of risk management techniques. Pillar 2 is the answer. Okay? Okay. Now tell me the correct answer. Which option is correct? Which of the following is a source of funds in the balance sheet of banks? Just give me a minute. Till then, read the question and try to give the answer which option is correct according to you. And these questions are basically taken from the Macmillan. Yes. So the sources of funds in the balance sheet of banks is basically the deposits that is accepted from the general public. This is the source of the balance sheet of the banks. Other three options are not able here. What is the feature of notice money market? Notice money market is a segment of Indian money market where short-term funds are borrowed and lent for a period of at least 2 to 14 days. It is a key part of the interbank lending markets where financial institutions trade liquidity to manage their short-term needs. So option A is correct here. Okay. Okay. I think this question is discussed. What is the process of what can be described as ALM? So it is the act of planning, acquiring, directing the flow of funds through an organization. Clear? How can the net interest margin be understood? It is a key profitability metric for the banks and the other financial institutions. So we can say the correct answer is spreading on earning assets because it represents the difference between the income earned on the assets and the interest paid on the liabilities. Okay. Tier 2 capital is restricted to dash 1 capital. Tier 2 capital is restricted to dash of tier 1 capital. We know tier 2 capital is restricted to 100% of tier 1 capital. This means the amount of tier 2 capital that a bank have is capped at an amount equal to its tier 1 capital. So 100% is the correct answer. How is any capital requirement arising out credit and counterparty risk to be met? Both tier 1 and tier 2 capital. Why? They are the categories of regulatory capital that banks must maintain to ensure that they can absorb loss and remain solvency. So here both options are correct. What is the recommended principle for ICAP formulation? Yes, very good, Sunil sir. In this, what is the recommended principle for ICAP formulation? I think for the ICAP formulation, it is a key component. I already told you about this of for the Basel third and Basel second frameworks, and in this requiring the banks assess and manage their capital adequacy in order to manage their capital adequacy, but in the relation to their risk profile. So it is basically encompasses firm wide risk profile. Okay. If this question is done, disclosure of capital requirements for the credit risk falls under which category? Which category? Basically, disclosures of the capital requirement for the credit risk falls under quantitative disclosures. Why? Because they provide some type of numerical data and the metrics that enables the stakeholders to assess the bank's capital adequacy and the risk exposure. These disclosures are complement like qualitative information and helping in analyzing of the bank's financial health. So the D option is correct. Yeah, very good, sir. This question is done. How is the significance in the erosion in the value of security reckoned? Sorry. See, erosion in the value of security refers basically to the decline in the market value of collateral or assets that a lender or financial institution has accepted to secure a loan or credit facility. And this concept is particularly important in the context of lending, investment and the risk management, because a decrease in the value of the security can significantly affect the lender's ability to recover the loan amount in the event of default. So here we can say option B is correct when the realizable value of the securities is less than 50% of the value assessed by the bank or accepted by the RBI. Okay. Yeah. What is the provision for a loss asset? 100% provision is there. So we can say full amount, that is 10 lakh. This question is done. This question is also done. So tell me the about this question and then we are done for today. Okay. What is the reason for the complexity in liquidity management for the banks with internal presence? Yes. Okay. See, in the event of disturbance, a bank may not always be able to mobilize the domestic liquidity to meet the foreign currency funding requirements. So the option B is correct here. Okay. Option B is correct. Okay. Measuring and managing the funding requirement can be done through the two approaches. One was is stock approach and second one is flow approach. I have told you this many times. Flow approach in contracts emphasizes the changes in funding requirements over the time. So the answer is flow approach is basically analyzes the inflows and outflows of the funds, considers how funding needs may evolve based on the factors such as cash flow projection, loan disbursements and the payment schedules. And which one of the following ratio should be higher for better liquidity management? That is the ratio of core deposits to the total assets. Okay, gap or mismatch risk. Gap or mismatch risk is basically a potential for the financial, basically potential for the financial losses which is arises from the differences in the timing of cash flows which is related to the assets and the liabilities. So option A is correct here. Okay, a gap or mismatch risk arises from the holding assets and liabilities within different principal amounts, maturity dates or repricing dates, thereby creating exposure to changes in the level of interest rates. Okay, now thank you, Sureen sir. I don't know, I am having cold, that's why I hide myself many times. Okay, uh, next question. What is basis risk? Basis risk, basis risk is a type of a financial risk that arises from the imperfect correlation between the price of a hedging instrument and the price of asset that being hedged. This disparity can lead to potential losses when the hedging strategy does not perform as expected. So we can say that basis risk is the risk that the interest rate of different assets and liabilities may change in different magnitudes. Embedded option risk, little, I think for some one more chapter, because we are taking now a Macmillan questions, because revision of these questions is also necessary. So I think 4 to 5 questions are also left. Embedded option risk. Embedded option risk, which is associated with the presence of embedded options. Embedded options in the financial instruments such as bonds, loans, or the derivatives. And an embedded options gives the holder certain rights such as the ability to convert, redeem, or extend the terms of the contract under specified conditions. Okay, so we can say here the correct answer is the risk of premature withdrawal of deposits and prepayment of advances. So the option C is correct. What is a crucial assumption in bond pricing formula? Bond pricing is not dependent on the financial strength of the buyer. And also bond pricing can be manipulated to suit the convenience of the buyer. This is not the crucial assumption. Bond prices here rise when the interest rate rise. This statement is also incorrect, because bond prices actually fall when interest rate rise. And if we talk about the fourth option, all coupon payments are reinvested at the bond yield to maturity. This is the correct exemption. The bond pricing formula assumes that all the coupon payments received are reinvestment at the same time as the bond YTM. So this option is correct. Now, while expected losses are covered by specific reserves and provisions, how are unexpected losses handled? If we talk about the unexpected losses, in the context of banking and credit risk management refers to the losses that exceed the expected losses due to some unforeseen circumstances. Also, unexpected loss is a measure of amount of economic capital required to support the bank's financial risk. Okay, so here in the given options, what we can say, which option is correct? Our option B is correct, that is through capital allocation based on confidence level, time horizon, diversification and the correlation. That means option B is correct. The pricing of product should provide a buffer against expected losses. What do unexpected losses indicate? Basically, unexpected losses also here measure of the amount of economic capital required to support the bank's financial risk. This is correct because unexpected losses reflect the potential loss that can occur beyond what is predicted based on the historical data. Financial institutions need to hold economic capital to cover these unexpected losses, ensuring they remain solvent and that can absorb losses in the adverse conditions. So option C is correct here. How is risk adjusted performance defined? I think this is easy. Yeah, very good. Risk adjustment performance is the measure to evaluate the return on an investment or the performance of an asset while considering the risk associated with it. Okay, so if we talk about this, is defined as profit for each unit of risk capital. This is the correct here. That means option D is correct. Okay. Okay. Now, other than Macmillan, there are also some 2-3 questions. I think these questions are there only. We cover because I think these are also important. What are the primary objective of FSBs? What are the primary objective of FSBs? FSB is Financially Stability Board. Basically, if we talk about this FSBs, these works to monitor and address the vulnerabilities in the global financial system and fosters the cooperation among national financial regulators to ensure a stable financial environment worldwide. It also plays a role in setting international standards of financial markets and institutions. So, the primary objective of FSBs is to promote international financial stability by coordinating national financial authorities and international standard setting bodies. Why did deregulation in the economy become necessary? See, if we talk about, sorry, I'll just wait for your answers too. See, deregulation. Deregulation was seen as necessary to create the greater competition with the financial industry, which reduces the government control and allow the financial institution to operate more freely. The idea was that reducing the regulatory barriers, banks and other financial entities would be able to offer better services, which innovate more quickly and contribute to the overall economic growth. So the correct answer is to foster faster growth by promoting competition and enhancing customer services. So, what is the concept of risk based capital in the regulatory framework implication? Just read this and try to give the answer. Yeah, correct. Deregulation in India with effect from 1993. Very good. See, the concept of risk based capital in regulatory framework like Basel II and Basel III implies that banks are required to hold a certain amount of capital proportional to the risk they take on. This ensures that banks have enough financial cushion to absorb the losses in those cases their risk where the risk exposures are there, and they do not perform as expected, and helping to maintain the financial stability. So in this case, banks should have capital aligned with the level of risk they undertake. So the option B is correct here. What was the CRAR benchmark set by Basel I Accord, also known as cookie ratio for international banks? See, according to the Basel I Accord, which is also known as cookie ratio, set the capital risk weighted asset, that is CRAR, benchmark at 8% for the international banks. This means that banks were required to maintain capital equal at least 8% of their risk weighted assets to ensure they could absorb potential losses and maintain the financial stability. So the answer B is correct here, that is 8%. Okay. Yeah, 8%. So that all the questions we covered, and today we covered at least 90 questions maybe. I hope that this class is helpful for you, and if yes, helpful, kindly subscribe to the channel and give the like to the channel. And thank you so much for giving your time for attending the session, and I will try to give my best in the upcoming classes. Thank you so much everyone. Thank you. Next YT is tomorrow at the same time, but for the final marathon the timing will be 6 p.m. tomorrow, 8 p.m. We will see the calculations based question and the case studies. Yes, tomorrow class is dedicated all the numericals of all the modules, important numericals and all the important case studies. And then after that we have final marathon in two parts, in which we will try to cover all the syllabus in the two marathons. Okay. So thank you everyone for giving your time, and we will meet again tomorrow with some new more questions. Thank you everyone, and have a good night, good day all. Take care all. Thank you.